remember a couple Thanksgivings where we had some quite significant drops in prices off the back of a headline. I think a lot of the traders that are sitting on the desks manning those desks over these two holiday days are instructed to cover aggressively in case something happens. And some of those moves often got compounded by negative gamma effects. Hello, and welcome to episode 15 of Oil Insights. I'm your host, Harry Tchilinguirian, Group Head of Research at Onyx Capital Group, and I'm joined today by Onyx Research Associates Mita, Chaturvedi, and Vincent. Before we start the show, please like and subscribe to the podcast. I also invite you to visit Onyx's LinkedIn and YouTube channels for more interesting and exciting content. Now, the dust is settling on Donald J. Trump's election as the 47th President of the United States, and significant and many cabinet positions have been filled. Yesterday on Truth Social, President-elect Trump indicated that on day one of his presidency, he would impose a 25% tariff on all products from Mexico and Canada, and an additional 10% tariff on goods from China. Earlier, Treasury nominee Scott Bessent developed key proposals in terms of the economy, including producing an extra 3 million barrels a day of oil equivalent. So now that the cabinet appointments have been made and policy proposals reinforced and reiterated, the oil market could focus on the here and now, at least until Mr. Trump takes office. The here and now is not, in our view, that much different from the circumstances the oil market faced before Mr. Trump's re-election. The macroeconomic outlook still looks weak, the Fed is in no rush to lower policy rates, and OPEC Plus, which meets on December the 1st, is caught between a rock and a hard place, likely forced to maintain the current levels of production restraint to avoid the build-up in stocks. Now, the shifting sands of geopolitics continue to buffet prices up and down, with the market focus shifting back to the war in Ukraine for some upside last week. In contrast, the latest developments in the Middle East this week suggest a potential for appeasement and lower tensions in the region regarding the confrontation between Israel and Hezbollah. Now, at the time of this podcast, front-month Brent futures was trading just below $74 a barrel. And as we noted in our previous episode, the market continues in its consolidating pattern. And that consolidation will eventually have to conclude with a breakout in one direction or another. So oil this week is going to have a shorter trading week, thanks essentially to U.S. holidays, Thanksgiving holidays on Thursday. And many traders will be away from their desks on Friday as well. If past Thanksgivings are any guide, we still need to watch for potential sharp shifts in the price. Now, while the onset of winter has only just begun, in this episode, we're also going to take a closer look at gasoil diesel in Europe and Asia, and whether seasonality is pricing in. As usual, our starting point for the podcast is a positioning of risk takers in the market and the commitment of traders data that runs the Tuesday of last week. So Vincent, could you walk us through the recent changes in the long-short positioning on Brent? Has there been any significant change relative to the previous weeks? I mean, it's my impression that despite the ups and downs that we've known over the past couple of weeks in terms of the net position, we don't really see that much further engagement by risk takers in the market. What can you tell us?
Certainly, Harry. So overall, the risk takers very much remain on the sidelines. However, looking closely at the data, we saw that long positions by money managers and Brent futures has been rising for the third week in a row. And net length is the highest since early October. That was following Iran's strike on Israel. So overall, the outlook is quite mixed because you have geopolitical tensions and the expectation of OPEC continuing their cuts supporting prices. But then agencies and banks are warning of a greater oil surplus in 2025. And of course, the market is quite tentative about the incoming Trump administration.
Mm-hmm. So in terms of net positioning, we've seen the position creep a little bit higher. But at the end of the day, if we go back to where it was a couple of weeks ago, we're not that far away. I guess we probably see the same kind of phenomenon when we start looking at it from a long to short ratio basis.
Yeah, not too much different from previous weeks. The week-on-week change, it's in Brent futures 1.8 to 2.3 to 1. So still quite bearish historically, but what is notable is that the long to short ratio in Brent has surpassed the long to short ratio in WTI for the first time since May this year. So that's a huge shift, and it's also worth mentioning that this also comes as the supply situation in the US has improved, and which has pressured the front WTI future spread, which expired recently, the Dec Jan. That was in contango this time last week.
Right. So from commitment of traders data to estimating what CTAs are doing, we find the same kind of pattern on Brent with this. We're getting this upward drift in positioning, but again, we're not necessarily in that position to say that the market has definitely deployed that much more risk and is readily re-engaging with oil.
Yeah, if anything, the market risk has become more balanced. So from the CDA positioning we've been seeing, it has risen for all of the contracts, but on Brent, that was on the chart you'll see went from minus 29 to minus 13K contracts in the past week. So that's reflective of the upwards move in price action. But looking at it from a longer term basis, we can deduce from the positioning is that it's relatively balanced and there is plenty of risk to be deployed on either side in the event of either a bullish or bearish catalysts.
Okay, so I mean, I guess perhaps for those of us who watch us a little bit regularly over the past couple of weeks, we're sounding a little bit like a broken record in terms of positioning. And we get that sentiment that we're waiting for Godot for things to change. Right now, in the here and now, Vincent, because we've kind of opined in previous episodes on longer term implications of a second Trump presidency. If we come back to the here and now, what are the sort of drivers for this week? What are we mainly looking at in terms of price direction? Because we've opined that Trump could be bearish for oil prices, sort of in a longer term view. But bringing it back to today and what's ahead of us, what do you think is going to be pushing markets this week?
Yes, of course. So there'll be three main ones in which I'll be expanding on Mita's Brent forecast published on Onyx LinkedIn already. So make sure to check it out if you haven't yet done so. So first one is seasonally low liquidity. Of course, as mentioned earlier, this week is the Thanksgiving holiday where market liquidity is traditionally lower. Trading volumes are decreasing, and that would be especially on Thursday and Friday. So with that in mind, low liquidity, there's potential for aggressive price action and position covering in either direction if such headline news comes out, which would cause sharp moves in prices and volatility. Of course, this week you have key macro news such as the FOMC minutes, as well as the US GDP inflation data. The inflation data, that's the PCE, which is the Fed's preferred measure for inflation. Mm-hmm. The next one, second one, Brent is approaching a technical resistance level. So the price on the front month Brent is having trouble moving above the longer term moving average. That is the 50-day moving average as shown in the charts. So price action has gone above a few days, a few sessions, but we haven't managed to see this confirmation of this breakthrough higher or to be sustained, with Brent price action invariably retreating back downwards. Mm-hmm. So $76 per barrel in front month Brent futures, that's proved to be a resistance level, but has ultimately retreated. And given the bearish outlook for oil demand in the longer term, we do expect this to continue. And the third and final one is mixed developments in geopolitical tensions. Last week, Russia-Ukraine geopolitics has come back to the headlines as there was escalations from both sides, with the US and UK allowing Ukraine to use their longer range missiles in Russian territory, albeit confined to the Kursk region. And then Russia retaliated soon after by firing a hypersonic intermediate range ballistic missile at the Dnipro region in response, hitting a facility. On Monday, the UK then began another sanctions package targeting Russia's shadow fleet, which has targeted 13 new named ships. But on the Middle Eastern front, Israel has reportedly agreed in principle to a ceasefire with Hezbollah in Lebanon, which saw crude prices deflate by $2 on Monday.
So, I mean, that's very interesting. I remember a couple of Thanksgivings where We had some quite significant drops in prices off the back of a headline. I think a lot of the traders that are sitting on the desks manning those desks over these 2 holiday days are instructed to cover aggressively in case something happens. And some of those moves often got compounded by negative gamma effects. Now, it's true that, off a headline with low liquidity, one move could then trigger a stop or could trigger a buy signal. Those Thanksgiving is always a tricky level. Technicals, we're going to get a little bit more into that. So we're having trouble moving, we're moving higher. I think it's quite interesting in terms of, our overall narrative of oil trading in a range that is given essentially by both OPEC cuts in terms of the floor and a weak macro outlook in terms of the cap. And in between, well, the ups and downs of geopolitics push prices around. Last week it was up. This week we're going down. So depending on how much, I guess, the market is going to weigh either one of these developments is going to be a factor in terms of how we move forward. So speaking about these technicals, I mean, last week with Martha, we sort of identified that Brent was in a downward channel. There was further room for consolidation. What do you see? What has happened since last week? Are the technicals sending any different signals than what we already had talked about?
Yeah, so as Brent continues to oscillate, we have seen since late September an emergence of a symmetrical triangle pattern, so in which Brent has been trading within that range, and we're now nearing the apex of that triangle. So what does that mean for the coming weeks? The indicators RSI and the MACD have been showing as relatively neutral, so which means that the market is consolidating and is not building momentum towards either direction. However, one thing we want to note is that the Bollinger Bands have been narrowing over the past few weeks, so and more narrow than earlier this month in November. And what this means is that this suggests a high probability of a breakout in terms of volatility and price action. So the fact that we are approaching the apex of the triangle reinforces our view that price action could break out in the coming future. In which direction, upside or downside, we're not sure, but
something has to give.
Something has to give.
It's certainly interesting because we've been looking at oil prices as they progress in this triangle, and with volatility coming off and reflected in the Bollinger Bands narrowing, that is typically from a technical point of view where you have to start paying attention. So again, we don't know what could set it off. It could be a news headline. It could be a fundamental event, an unplanned outage, you name it. It's always difficult to tell, but it's interesting to see that we're now getting towards the apex of that triangle. The Bollinger Bands are narrower. And so we were opining, I think the last episode, where we don't know which way it's going to break out. Being long strangle strategies is certainly something to consider. But in terms of crude right now, steady as she goes, and we're not really seeing much movement. So let's turn to products with Mita. This week we're going to be focusing on gasoil, diesel. Now winter is approaching relatively quickly. We already had a bit of a cold spell last week. And so the question, I guess, is gasoil, diesel beginning to price in the winter seasonality? So we know that, of course, it had been impaired by weak manufacturing and industrial production type data. But again, it's that time of the year where typically, at least gasoil, diesel sees somewhat of an uplift, right? So what are we seeing in Europe and in Asia?
Yes, of course. So right before recording at around 11 a.m. GMT today, the Jan 25 ICE gas oil crack was just under $18 a barrel. We have seen, as you mentioned, an upward trend since the end of October. We were initially seeing resistance around the $17 handle. This is in the past 2 months. But we broke past this point on 13th November. Seasonally, we are higher than seen in years prior to 2021, although this time last year, the crack stood at 21.50. and year before that was in 2022, the crack was unseasonably high. Nonetheless, this current support is definitely linked more in the crack is definitely linked more to the product side than it is to crude. The front-month gas oil futures spread has rallied from a low of $0.75 per metric ton, so that's 75 cents on the 1st of November, to a steeper backwardation of $8.50 on just again at the time of recording, yes, indicating tight supply. Fundamentally, as you mentioned, temperatures have dropped in Northwest Europe. It was -1 degree Celsius this time last week in London. Diesel and gas oil stocks in the ARA, which is this is data by BJK International, dipped by 1.9% in the week ending 21st November. And so I have seen a lot of talks of tightness on the basis of this. But that said, a further look at the ARA data also shows that levels are 30% more than they were this time last year and 7% up month on month. Another, I guess, potential point of support could be a decline in exports from Asia and from India specifically and the Middle East, with swing barrels directed to Asia instead with the rising east-west. The Indian government's Petroleum Planning and Analysis Cell also mentioned that India's middle distillates exports fell by nearly 17% in October. That's month on month, in line with the end of monsoon, festival season, now marriage season in India, but still rose by nearly 14% year on year. So I guess it'll be interesting to see how India's November exports come out, but I think just with the east-west also declining now, barrels will likely go westwards as well. And with things just being well supplied year on year, I see little of the limited supply argument everyone's talking about.
So that would be just a sort of transitory period.
I think so, yeah.
Because if we're talking about lower arrivals in Europe, and that could be also off the back of refinery maintenance and limiting how much was exported to arrive in October and into November. Post-maintenance, I think probably in the case of Europe, then we should see a lot of those export levels resume more normal levels, right?
For sure, yeah, I completely agree. So I do think this is more just we're transitioning towards wintertime and just like a rise in diesel demand seasonally. But I don't necessarily see the tightness everyone's talking about. Still, this support in the immediate short term is significant and could carry weight in the near term. CFTC data for the week ending 19th November saw money managers in ICE gasoil switch from net short to net long for the first time since the end of July, with the current money managed long short ratio up at 1.5 from 0.8:1 last week. In Asia, the Singapore 10 ppm gas oil crack has also been supported in Deccan and Jan, although we're now seeing resistance around the $16.50 handle. The Dec-Jan spread has been trading sideways for most of November, but the Jan-Feb spread has been interesting. It's risen from around flat on the 1st of November to 30 cents per barrel right before recording. Fundamentally, in Asia, China's decision to cut tax rebates for the exports of clean petroleum products could have helped improve sentiment in gas oil. Export costs rising for Chinese refiners would mean less product being shipped to Asia, and the lack of this supply would be felt more towards the beginning of 2025, with Q1 2025. We could see longer haul diesel supply coming in from the US Gulf Coast, but for that to reach Asia, I guess that will all be just a little more medium term than right now. That said, excluding China, we still expect gas oil supply in Asia to rise in Q1 next year, potentially capping how high the crack can go. If you look at refiners, for example, we could see other non-Chinese suppliers step up and produce diesel. Right now, we could still see some strength because these refiners would also have to produce kerosene, just given seasonal kero production for wintertime heating. But following that, I guess we could, if this supply tightness continues from China's end, we could see other suppliers step up and produce more diesel.
So it's interesting. We have this dynamic where obviously it's a flat price in the product that's driving the crack higher in both Europe and Asia. And I guess for different reasons, we're drawing support. So you were mentioning obviously that in terms of price structure, the shape of the curve, Europe is definitely indicating a relative scarcity of supply. And that, we've seen a dramatic decline in the October levels of exports from the Middle East to Europe, some decline from the US. But that's all sort of transitory. And the same thing, I guess, could be said when it comes to Asia, where effectively maybe the fact that the tax rebates for Chinese refiners and in terms of exporting their product will be reduced, it doesn't preclude other refiners, export-oriented countries such as South Korea to step in, even as though they still are committed to producing a certain level of kerosene for heating needs. I think that, what's certainly interesting is to maybe to look at this and saying, well, without cold weather in the Northern Hemisphere, it may be a bit difficult, I suppose, if we reinstate a normal supply situation. It may be a little bit difficult for the crack to rocket to the moon, so to speak. But if we were to turn and look at this from a technical perspective in Europe, and if we were to look at just how the ICE gasoil Brent crack has been behaving, is there any signals we could glean from the chart patterns or the relative movement of the different indicators that people look at in terms of technical analysis? Tell us where this crack is going.
For sure. So again, as I mentioned, that the gasoil crack has been supported. You can see this on a technical basis as well. So on first glance, we notice that the crack has moved above its short and longer term moving average, which in what could be considered a golden cross configuration. The short term moving average is also above the longer term moving average, which again does lead to indication that we are currently seeing more upside support. More interestingly, the shorter term moving average is also providing to be support in the recent uptrend in prices. So we see this is the 10-day moving average. We see prices hovering just above it for quite some time now, seeing support at this critical level. We also have a possible double bottom pattern with troughs seen in mid-September and in October, with the crack and now we've seen the crack moving convincingly above the baseline, having pulled back just right before it. But we have seen it gone, I think for the past week, we've seen the crack go convincingly above the baseline from this double bottom pattern, which is pretty indicative of the upside momentum that we're seeing right now.
Two reinforcing technical factors: golden cross and double bottom.
Yes.
Bit of a throwback before crossing the baseline, but we're now significantly above that for a number of sessions, and it just seems that the momentum, I think, is still there. Does RSI tell us anything as to whether or not we have exhausted this momentum, or maybe there's further to go?
So the RSI indicates that we're currently still in the neutral territory. So we still have room for further upside in the crack itself. And when you look at potential resistance levels, if we are going to be in this upside for the next medium term at least, we identify resistance points at around $21 a barrel, which is a level which was twice support earlier this year in like January and April, and then turned resistance around early July. And if you look at Fibonacci retracement levels taken from the peak for the crack in around February to September, we see that the 38.2 retracement dovetails with this $21 per barrel resistance level that we've identified. So if I had to take a view on the crack in the near term, I would say that from its current $17.8 per barrel level, there is potential to move up by $2 to $3.
Okay. So a bit of upside until we hit that 38% retracement level. And then again, perhaps the weather patterns and the weather prognostics will change and shift sentiment on the market. Thank you very much, Mita. And this brings us now to the usual crystal ball moment of our show. And of course, we're going to be trying to give our sentiment on where oil prices are going to be by the end of this year, just before Mr. Trump takes office for a second time. So, Mita, do you have a view on whether Brent will be trading above or below $70 by the time we get to, let's say, at the end of this year, December, or even early January?
I do think we'll continue to see support around $70. I don't think we're going to dip below it. We still see the Russia-Ukraine war, and which has a larger impact on oil supplies as well. OPEC Plus, in my opinion, will also not bring back barrels until the latter half of next year, which should keep things above $70 for now. It will be interesting to see how the Jan Brent expiry goes at the end of this week for just for some more idea of how direction is going to go next month and into next year. And it'll be interesting to see if we get if we get more details or more nuggets from Donald Trump about what his plans are with respect to tariffs and just other economic policies.
Okay. Vincent, do you share Mita's view?
Sure, yeah, I do. Yes, I do expect Brent futures to also remain above $70, at least until the end of the year. As we saw last week, geopolitical risk premium remains elevated, remains in the market's purview, while OPEC are widely expected to continue to roll over their voluntary cuts into the new year. So these factors should provide a baseline level of support. In addition, as Mita had mentioned, the recovery of distillate cracks, but also gasoline cracks would be a positive sign for crude demand in the near term, especially in the physical market. So until further headlines, whether geopolitical or economic, provide a catalyst for either an upwards or downwards move, I expect flat price to continue trading in the low 70s until the end of the year.
Okay, so relative to what we said earlier, we're going to have a breakout, but both you guys are still thinking that whether, I suppose if we are going to break out, then it's going to be more to the upside than to the downside. My personal feeling is that the fundamentals are pretty heavy right now, and they're weighing on prices. And I guess in terms of how the market is going to trade, we'll still have that OPEC plus meeting on the 1st of December, where a number of people, and as you were mentioning, Mita, are relatively convinced that they are basically boxed into a situation where they will have to maintain current production cuts just to balance the market and avoid excess buildup in inventories. So to me, depending on what they do, of course, and other factors, and this could be, for example, the Fed taking its sweet time to reduce interest rates in view of maybe development in inflation expectations or how they see the economy moving forward. All these things could mean that we could certainly test, in my view, in the interim period, maybe below 70 before coming back up, because I suppose at the end of the day, when in doubt, because there's going to be a lot of doubt relative to the onslaught of executive orders that will be signed on the first day of office of Mr. Trump. If you're in doubt in oil, I think most people like to be long rather than short. So it could be that the market initially buys it's no longer the rumor of President Trump, buys the Trump presidency only to sell afterwards once we've actually are fully aware of everything that he wants to do in the immediate future. Well, with that, we're at the end of this episode. So thank you very much for joining us. As always, smash that like button, and we'll see you next time. Thank you, guys.
Thank you.
Thanks.